Okay, stop what you're doing for a second, because what happened this week in the markets is one of the biggest moves we have seen in years, and most people have no idea why. On Friday, January 30th, gold crashed 11%, silver collapsed 31%, its worst single day since 1980. The S&P 500 dropped, the Nasdaq dropped, and the US dollar surged, all of it in one day because of one man, Kevin Warsh, Trump's pick to be the next chair of the Federal Reserve. Now, if you don't know who Kevin Warsh is or why any of this matters, that's exactly why you're watching this video, because understanding what just happened and what happens next could be the difference between making money in this market or getting destroyed by it. So let's break it down from the very beginning: who Kevin Warsh is, what the Fed actually does, why gold and silver crashed, what it means for stocks, and most importantly, how you should be trading this. Let's go. First, let's talk about the Federal Reserve, because if you don't understand what the Fed does, nothing else makes sense. The Federal Reserve is the central bank of the United States. Think of it as the government's bank. But here's the key thing: it's supposed to be independent, meaning it makes decisions about interest rates based on the economy, not based on what the president wants. And why does that matter? Because interest rates control everything. They control how much it costs to buy a house. They control how much businesses pay to borrow money to grow. They control how attractive stocks are compared to bonds. They control the strength of the US dollar, and they control how much demand there is for safe haven assets like gold and silver. When the Fed lowers interest rates, money gets cheaper, people borrow more, businesses invest more, stocks go up, the dollar weakens, and gold and silver tend to rise because there's more money chasing assets. When the Fed raises interest rates or keeps them high, the opposite happens. Money becomes expensive, people save more, stocks can fall, the dollar strengthens, and gold and silver can come under pressure because holding them becomes less attractive when you can earn a decent return just sitting in cash. So whoever sits in the Fed chair position has enormous power over global markets. And this week, that chair is about to change hands. Now, let's talk about what happened before Kevin Warsh was announced, because the context is critical. Going into this week, the market was already in a very unusual state. Gold had just hit an all-time high above $5,580 per ounce on Thursday. That's up more than 80% over the last 12 months. Silver hit a record above 120 welts per ounce. These are historic jaw-dropping numbers. Why were gold and silver surging? Three reasons. Number one, fear of dollar debasement. A lot of investors believed that Trump was going to pressure the Fed into cutting interest rates aggressively, not because the economy needed it, but because Trump wanted cheaper borrowing costs. If the Fed is cutting rates just because the president told them to, the dollar loses credibility. And when the dollar loses credibility, people flee to gold and silver. Number two, geopolitical chaos. Trade wars, tariffs, tensions in the Middle East, uncertainty about the global order. When the world feels unstable, people buy gold. Period. Number three, central banks around the world have been buying gold at record levels for over a decade. China, India, Russia, they're all diversifying away from the dollar. That's a massive structural demand that was pushing gold higher and higher. So gold was at all-time highs, silver was at all-time highs, and then on Friday morning, everything changed. Here's what happened. On January 28th, the Fed held its first meeting of 2026. Jerome Powell, the current Fed chair, kept interest rates steady at 3.5% to 3.75%. That was the first pause after three consecutive rate cuts in 2025. Powell said the economy is on a firm footing and that the Fed would let the data guide future decisions. Trump was not happy. He posted on social media, "The Fed should substantially lower interest rates now." But the bigger story wasn't the rate decision. The bigger story was what came 2 days later. On Friday, January 30th, President Trump announced that he is nominating Kevin Warsh to replace Jerome Powell as the next chair of the Federal Reserve, and the markets absolutely lost their minds. So who is Kevin Warsh, and why did his name alone cause gold to drop 11% in a single session? Kevin Warsh is 55 years old. He grew up in Albany, New York. He went to Stanford for his undergraduate degree, then Harvard Law School. After law school, he went straight to Wall Street, Morgan Stanley, where he worked in mergers and acquisitions from 1995 to 2002. He became one of the youngest executive directors at the firm. Then in 2002, he left Wall Street and joined the George W. Bush White House as a special assistant for economic policy. He served on the National Economic Council. And then in 2006, Bush nominated him to the Federal Reserve Board of Governors. At 35 years old, he became the youngest person ever to serve in that role. This is important. Warsh was not some random pick. He is a former Fed governor who served during the 2008 financial crisis. He was Ben Bernanke's liaison to Wall Street during the darkest days of that crisis. He was directly involved in the Bear Stearns rescue and the AIG bailout. He knows how the system works. He knows the players. He knows the stakes. After leaving the Fed in 2011, Warsh went back to finance. He became a fellow at the Hoover Institution at Stanford. He taught at Stanford Business School. He partnered with billionaire investor Stanley Druckenmiller at the Duquesne family office. And he married into the Lauder family, the Estee Lauder empire. So this is not a random outsider. This is a Wall Street veteran with deep connections in both finance and politics. But here's where it gets complicated, and this is why the market reacted the way it did. For most of his career, Kevin Warsh has been known as an inflation hawk. That means he historically favored higher interest rates to keep inflation under control. Even during the 2008 crisis, when everyone was panicking, Warsh was warning that quantitative easing, the Fed buying bonds to flood the economy with money, could lead to inflation down the road. He actually resigned from the Fed in 2011 because he disagreed with the Fed's decision to keep buying bonds. He thought it was reckless. So here is a guy who historically has been more hawkish than Jerome Powell, more concerned about inflation, more skeptical of easy money, and Trump, who has been screaming for rate cuts for months, picked him. Why? That's the question Wall Street has been asking all weekend. And honestly, there are two possible answers. Answer number one, Warsh is genuinely independent and Trump picked him because he respects his credentials. In this scenario, Warsh becomes Fed chair, maintains independence, keeps rates where they need to be based on data, and Trump just has to accept it. This would be good for the dollar, good for financial stability, and great for investors who were worried about the Fed losing its credibility. Answer number two, Warsh made a deal. Trump picked him because Warsh privately agreed to eventually cut rates when the time comes. In this scenario, Warsh plays nice for a while, but slowly bends to political pressure over time. Elizabeth Warren already accused Warsh of being a sock puppet who softened his stance just to get the nomination. The truth is probably somewhere in the middle, and that's exactly what the market is pricing in right now. But here's what matters for your portfolio. The immediate reaction to the Warsh announcement was actually a vote of confidence. Think about it. Before the announcement, there were rumors that Trump might pick Kevin Hassett, the current director of the National Economic Council, someone basically working directly for Trump. If Hassett had been picked, the market would have interpreted that as the Fed is no longer independent. It's just going to do whatever Trump says. That would have been catastrophic. Rates would get cut aggressively. Inflation would come back. The dollar would crash. Gold would go to $7,000. But Trump didn't pick Hassett. He picked Warsh, a former Fed governor with a hawkish reputation and deep institutional knowledge. And the market's response was immediate and dramatic. Let's talk about what happened to gold and silver, because this is where the real money was made, or lost, on Friday. Gold had hit $5,580 on Thursday. By Friday afternoon, it was down to around $4,745. That is a drop of over $800 in less than 24 hours, roughly 11% gone in one day. Silver went from a record high above $121 on Thursday to settling at $78.53 on Friday. That's a drop of 31.4%, the worst single day for silver since March of 1980, 46 years. Now, why did this happen? It comes down to one concept, the debasement trade. For months, a huge number of investors had been buying gold and silver as a bet against the US dollar. The logic was simple. If Trump forces the Fed to cut rates aggressively for political reasons, the dollar loses value and gold becomes the new safe haven. This is called a debasement trade. You're betting that the currency is going to lose its purchasing power. When Trump picked Warsh, someone the market perceives as independent and hawkish, that debasement thesis suddenly weakened. If Warsh is going to keep rates higher for longer based on data, the dollar is going to be fine, maybe even strong. And when the dollar strengthens, gold and silver become less attractive. Investors who had piled into precious metals on leverage, meaning they borrowed money to amplify their bets, suddenly got margin calls. They were forced to sell, and forced selling at scale causes exactly what we saw, a violent, fast crash. Evercore ISI said it perfectly. The Warsh pick should help stabilize the dollar and reduce the asymmetric risk of deep extended dollar weakness by challenging debasement trades. That single sentence explains everything that happened in precious metals on Friday. Now let's talk about stocks. The S&P 500 dropped 0.4%, the Nasdaq dropped 0.9%, the Dow fell 179 points. The stock market reaction was actually more muted than you might expect, and here is why. For stocks, the Warsh pick is a mixed bag. On one hand, if Warsh keeps rates higher for longer, that's actually bad for stock valuations. Higher rates make future corporate earnings worth less in today's dollars. That's why growth stocks, tech stocks, high PE stocks are under pressure. On the other hand, Warsh preserving Fed independence means the financial system remains stable. No reckless rate cuts that spark inflation, no currency crisis. That's good for the long-term health of the market. So stocks are caught in the middle. They went down on Friday, but not catastrophically. The market is essentially saying we're okay with this pick. It's not the worst case scenario, but it does mean rate cuts are probably further away than we thought. And that's the key takeaway for stocks. Rate cuts are being pushed back. Futures markets are now pricing in at most 2 rate cuts for all of 2026. Some analysts think there might be 0 cuts this year. If you own a lot of growth stocks, tech, AI, high growth names, this is something you need to pay attention to. These stocks had been rallying in part on the expectation that the Fed would keep cutting rates and making money cheap. If that doesn't happen, valuations need to come down. Now, let's talk about the dollar. The US dollar index surged on Friday. It gained against virtually every major currency. Why? Because a stronger Fed chair, someone who won't just cave to political pressure, means the dollar remains credible as the world's reserve currency. Investors around the globe hold dollars because they trust the US financial system. If that trust erodes, the dollar falls. The Warsh pick suggests the trust is holding. Francesco Pesole at ING called it exactly right. He said the dollar has been waiting for a catalyst for a recovery, and Kevin Warsh offers exactly that. But here's the thing, and I want to be honest about this. The dollar's recovery might not last. Trump's tariff policies, the geopolitical tensions, the national debt, those are structural problems that one Fed chair can't fix. So the dollar might bounce short term, but the longer term trend could still be weak. Okay, so that's what happened. Now let's talk about what happens next and how you should be thinking about trading this. Let me give you my honest analysis. First, on Kevin Warsh and the Fed. I think the market is right to be cautiously optimistic. Warsh is a credible pick. He has the experience, the connections, and the reputation to maintain the Fed's independence. But, and this is a big but, he has to get confirmed by the Senate first. And that's not guaranteed. Republican Senator Tom Tillis has already said he will not vote to confirm any Fed nominee until the Department of Justice drops its criminal investigation into Jerome Powell. That investigation was widely seen as political intimidation. Until it's resolved, Warsh's confirmation is in limbo. If Warsh doesn't get confirmed, or if Trump picks someone else, all bets are off. The market could reverse everything it did on Friday in a single session. So confirmation risk is real. Watch the Senate Banking Committee hearings closely. Second, on interest rates. Powell's term ends in May. He has two more meetings before he leaves. The next one is March 18th. Most analysts expect the Fed to hold rates steady through March. JP Morgan doesn't expect a cut until summer at the earliest. Under Warsh, the big question is whether he cuts rates at all in 2026. His hawkish history suggests he'll be very cautious, but Trump's pressure and Warsh's recent comments suggest he might find reasons to cut once or twice later in the year. My take? One cut in the second half of 2026, maybe two if inflation continues to come down, but nothing aggressive, nothing dramatic, and nothing that looks like it's being done for political reasons. Third, on gold and silver. Here's where I have a strong opinion. Friday's crash does not mean gold and silver are done. Let me be very clear about that. Gold is still up more than 60% over the past year, even after Friday's drop. Silver is still up over 150% year over year. The structural reasons why gold was rising, central bank buying, geopolitical uncertainty, national debt concerns, those haven't gone away. What happened on Friday was a correction, a violent, painful correction, but not the end of the trend. The debasement trade weakened. It didn't disappear. Trump is still president. Tariffs are still in play. National debt is still growing. Central banks are still buying gold. So, what does that mean for how you trade it? If you were long gold or silver going into Friday and you got stopped out, painful lesson learned. Leverage in commodities will humble you fast. If you're thinking about buying gold or silver now at these levels, I think there's an opportunity here, but you need to be patient. Gold pulled back from 5,508 us to around 4,145. That's a 15% correction. In a bull market, corrections of 15 to 20% are normal and healthy. I would not chase it right now. I would wait. If gold pulls back to the $4,500 to $4,600 range, that's a better entry point. If silver drops to $75 or below, that's where I'd be looking to accumulate. The long-term bull case for gold is still intact. It just got cheaper to buy. Fourth, on stocks. Here's my take on how to position your portfolio. The biggest immediate risk is to high growth, high valuation stocks. If rate cuts are pushed back, the PE multiples on tech stocks are going to compress. Companies like Palantir, Tesla, Rocket Lab, anything trading at 40 or 50 times forward earnings, these are vulnerable, but that doesn't mean sell everything. It means be selective. Value stocks, companies with strong cash flows, reasonable valuations, and real earnings, these actually benefit from a stable Fed. Banks, insurance companies, industrials. If the economy stays strong and rates stay higher for longer, financials could outperform. Defense stocks are another area worth watching. With geopolitical tensions elevated and the US military budget growing, companies in the defense sector have pricing power and predictable revenue streams. That's a safe harbor in a volatile environment. And finally, and I know this sounds counterintuitive, the Warsh pick might actually be good for stocks in the medium term. Here's why. If the Fed maintains its credibility, if inflation continues to come down gradually, and if the economy stays strong, then the Fed can cut rates when it actually makes sense to do so. Not because Trump screamed at them, but because the data supports it. That's a much better environment for stocks than a scenario where the Fed is cutting rates out of political fear and inflation comes roaring back. So my overall strategy coming out of this week is this. 1. Reduce exposure to high multiple growth stocks. Not sell everything, but trim the risk. Take some profits on names that have run up 100% or more. 2. Add to or initiate positions in value stocks, banks, industrials, defense. These are the winners in a higher for longer rate environment. 3. On gold and silver, don't panic sell, but don't chase either. Wait for the dust to settle. If gold pulls back to $4,500 or below, start building a position. The long-term trend is still bullish. 4. Watch the Senate confirmation hearings for Warsh. This is the single biggest risk right now. If he doesn't get confirmed, everything reprices overnight. 5. Pay attention to the March 18th Fed meeting. That will give us the first real signal about where rates are headed under the new regime. And 6, keep some cash on hand. This market is going to be volatile for weeks. Opportunities are going to present themselves. You want to be in a position to act. Look, I know this is a lot of information, but here is the bottom line. Kevin Warsh's nomination was actually a good thing for the long-term health of the US financial system. It suggests that even under enormous political pressure, the Fed is going to remain somewhat independent. That's what markets need to function properly. But short-term, it's going to cause pain. For gold and silver bulls, for growth stock investors who were betting on rate cuts, for anyone who had leverage in precious metals, the market is repricing, and repricing is uncomfortable. But it's not the end of the world. The smartest thing you can do right now is understand why these moves are happening, not just react to headlines, because the headlines are going to keep coming. Every day this week, every day next week, Trump is going to keep talking about rates. Warsh is going to have his confirmation hearings. The Fed is going to keep meeting, and every single one of those events is a trading opportunity if you understand the mechanics behind it. That's what we're here for. That's what this channel is about. Breaking down the complex stuff so you can make informed decisions with your money. If this video helped you understand what happened this week and why, drop a comment below. Tell me what you think about the Warsh pick. Are you bullish, bearish? Did you get hit by the gold and silver crash? I want to hear from you, and if you found this valuable, hit that subscribe button, because next week we're going to be tracking Warsh's confirmation hearings, the next Fed meeting, and how all of this plays out in real time. You don't want to miss it. Thanks for watching, stay sharp, and I'll see you in the next one.